Welcome to Grow Your Wealth, a series brought to you by BQ Prime and powered by Grow, an investment platform that's easy, fast, and transparent when it comes to investing. Now, as financial markets capture the minds and imagination of more and more Indians who want to look beyond fixed deposits, mutual funds, and the traditional investment platforms to invest in India's stock markets, this series seeks to explain and demystify what exactly are fundamental and technical analysis as two forms of studying the stock market, and it will help investors take calls on whether they should buy, hold, or sell a stock. Today, the topic that we'll be looking at is the top 10 trading indicators that every trader should know. There are quite a few of them, but here are the top 10 of them that every investor must understand. The very basics of technical analysis, if we could call it that. Now, to help us understand this topic, we have with us Dr. C K Narayan. He is a veteran of India's financial markets and respected as one of the finest exponents of technical analysis in India. He brings along with him nearly 4 decades of experience and insights on the Indian equity market. He's been a part of large broking houses. He's catered to individuals at the retail level and also headed large institutional desks servicing FIIs. He's also the founder of Neo Trader, an AI-based trading and analysis software. Dr. Narayan, welcome to this episode of Grow Your Wealth.
Thank you for having me on this.
Well, Dr. Narayan, I'm sure you may have as well started off with understanding these basics when it comes to technical analysis. So share with our viewers as well, what are the top indicators that every trader should know when they start off with?
Well, when you set out to do technical analysis, you first begin with the price. So price itself is the biggest, kind of indicator if you want to take it. So price can be seen in different forms, right? So that is the part of the charting repertoire that one has. And primary among them is something called as a candlestick chart. And you can look at the prices through the medium of a candlestick chart. So that becomes one of the most widely used forms of charting. And you could call it as a kind of an indicator because there are so many aspects to candlestick charting, which gives us a lot of information. Then there are, of course, other types of price charts, which are, some of them are oriented towards their being there for every day, every week, or every data point. And there are some which do not take the element of the time into it. These are called, point and figure charts or Renko charts and Kagi charts. So there are different types of charts. Each of them becomes a different way of looking at the prices. So price is the biggest. Second, when you collect all these information on the prices, they start to form some sort of a pattern. Now, the patterns are also very, very many, and you got something like traditional patterns, which are the older forms of looking at charts when, things like, computers, etc., were not there. Then later on, you had the patterns which emerged out of what are called as various kinds of mechanical tools, which could be derived through the use of a computer, etc. So there are a whole lot of analysis that could be done on patterns. So that is another big bunch. Then the third way of looking at it is through momentum. So momentum is an area in technical analysis which actually started somewhere in late 70s, early 80s with the advent of the personal computer. And after that, there has been a great surge in momentum indicators, and they also give you patterns of various nature. So these are pretty much the areas when you come to saying, give me some indication of what prices are doing. So you have price as an indicator, you have patterns as an indicator, you have momentum indicators, all of them collectively, and within them you have other styles of charting, something called Ichimoku chart, Heiken-Ashi chart. They also have various kinds of setup. So there are very many indicators that you can use within technical analysis.
Okay, you've discussed quite a few of them, Dr. Narayan, but let's pin it down to just one or maybe two. In your 40 years of experience, Dr. Narayan, which, according to you, is the closest to accurate indicator? And I'm choosing my words carefully because, of course, no method or tool can perfectly predict what the market could do next. So yes, what according to you is the closest to accurate indicator? What does it tell you about the market?
Well, you see, when you're speaking about indicators, then it all boils down to two things. The construct of the indicator. If you make it fairly complicated, then it takes a longer time and lesser clarity when it gives you some kind of an indication. The other side is to have something which is very, very simple. Now, when you have something very simple, it will try to mimic the price to a large extent. But then what really happens is that something which is very simple is far too close to the actual price, and one which is a little more complicated or more detailed is a little smoother and then a little away. So that is why there is a huge array of indicators which kind of sit within this whole range of very close to the price and far away from the price. And there is really no one favorite. It all depends on the individual, that through usage, what is it that they are comfortable with, right? So typically, most people, after looking at many things, after the price itself, they settle down something like, a momentum indicator. Now, a momentum indicator is something which mimics the price, but with a little bit of lag. Now, the construct of the momentum indicator will decide how much of lag will actually exist. Now, we really want to build one which is ideal, meaning that it does not lag it too much, but it does not become a substitute for the price either. So it has to fall somewhere in the middle. I think that particular chapter is too detailed for me to, kind of encapsulate in a single line. But I would say that if you were to look at momentum, there are lots of momentum indicators. They give you the current read of the market, like what is happening right now. And then many of them have a little bit of predictive value. So they also tell you what lies in the immediate future. So you need to make a good kind of combination. An example that I would give, which is very, very widely used, is something called relative strength index, which is the RSI for short. And the RSI is, I would think, used by maybe 98% or 99% of technical analysts across the world. So that should say something about its robustness and reliability. So I think if you must use some indicator, then it has to be the RSI as the number one indicator.
So, Dr. Narayan, do you think you could share with us an example or show us a chart that would indicate this RSI as you mentioned?
Certainly. I think, just allow me to share my screen. And if you look at it, this is a chart. And at the bottom panel, you have something called the RSI, which is the relative strength index, right? Now, the relative strength index measures the strength of the price action against itself. That means each bar is compared to the earlier sets of bars. And that kind of gives us an indication of what prices are actually doing, right? So this sort of becomes a way that we can look at prices. Here we are seeing prices go down, and then certain patterns set up on the chart here, which once you learn how to interpret something called the RSI, the relative strength index, you would be able to know that as this particular stock was coming down into these levels, it was actually losing steam on the downside, and that there would be a turnaround which would send it up. And as we can see now, the RSI here was giving out those signals, and then the stock has turned around and moved up. So these are the kind of things that an indicator, a momentum indicator, will do. As the prices go to a certain level, the momentum flips around to the other side and warns us of some imminent change in direction. That is what indicators really do, and that is what the RSI does. And I think it's one of the best at doing that job.
Okay, I think that gives us a pretty decent and a very comprehensive explanation of what an RSI is. Now, we've spoken about quite a few indicators, as you did discuss with us earlier. What or are there instances rather of conflicting signals among chart indicators? And if yes, how does one resolve it?
Well, we just spoke about the RSI indicator, right? That's a momentum indicator. So you have many, many such momentum indicators. Let's dwell on that right now. See, price action is a reality. because prices are formed by the action of people who are, who are engaging in buying and selling in the market, and that is what really creates the price. So price action is a reality. Whereas momentum, which is a derivative of price, an indicator which is a derivative of price, that can only be suggestive or indicative of what the price is actually doing. So if we have to choose between the two, then you must choose the reality, which is your price action, and you must marry the indication to the reality. So you have, like, the simplest example that I can give you is that during rainy season you look out of your window and you see dark clouds in the sky. They are indicative of a potential rainfall, right? But they are just indicative of a potential rainfall. It does not mean that there is rainfall actually. The real evidence of rainfall is when you feel the first droplet of rain on your skin, right? So similarly, all these momentum indicators, for example, they will give you an idea of what is likely to happen, but the price action finally is the final proof. So what we need to do is marry the price action to what the momentum indicators are suggesting. And when you do that successfully, you will be warned in advance of what is likely to ensue in the market. And that is where the whole game of using indicators really lies. You have to marry it to the price action. And when you learn to do that well, you will not only be able to read what is happening in the current, but will also be able to forecast with a reasonable degree of certainty of what is likely to happen.
So from your answer, Dr. Narayan, it's quite evident that you must use these indicators in conjunction or together. Could you share with us an example of how you use momentum to show you or indicate what exactly could happen and then confirm it with price action?
Sure thing. See, if you take momentum indicators and look at them in isolation or by themselves, they will give you some signals, right? And it's only when you conjunct them with the prices that you will be able to convert it into action, right? So when you combine the two, it provides some kind of a context. Let me show you that on a chart. Allow me to share the screen with you again. And I'll share with you the same screen which I had shown you earlier, right? Here is the chart which I had shown earlier, and here is price moving down. Okay, so one of the patterns or one of the signals that emerge out of momentum indicators is that as prices unfold, like you can see here, prices have been going down for quite some length of time. As they go extend for a little while, they start to lose momentum. In the sense, it's like a runner or somebody who's running. After running, let's say 100 meters, he or she probably gets a little winded, and the pace at which he can keep running that starts to slow down. Exactly something similar happens with the prices. So they are running down, and you can see here the momentum indicator is also running down pretty sharply. And then you come over to this area where the price is still running lower. This low is actually lower than all these previous lows. But if you look at the momentum indicator, which actually measures the momentum at which prices are moving, you're seeing that they have started to slow down. And this is a setup which we call within momentum as a pattern of divergence. So this is just one of the patterns which comes up. And when you see this kind of divergence pattern come up on the chart, you know that a turnaround is ahead. So this is how combining an indicator with the price action and then sort of putting it together will give you an idea, or it provides a good context in which to say that yes, prices are going down, but now they are going down with lesser momentum, and hence they are liable for a reversal, which you can see at the end of this chart that the prices did indeed reverse and have started going up. This is the value of various momentum indicators.
Well, this is very interesting indeed, Dr. Narayan, especially the fact that you've been able to sort of explain exactly what you said by way of an example. So thank you so much for that. Lots of indicators to choose from. And I'm sure as our viewers practice, they will be close to perfect. Dr. Narayan, thank you so much for joining us in what has been yet another very interesting episode of Grow Your Wealth. With that, we wrap it up.